Hi, Todd Garneau here with Three Creeks Capital. Today I'm going to talk to you about the widow's penalty. Very misunderstood concept about what happens when one spouse passes away and the impact it has on your tax return and potentially your Medicare Part B premiums. We call it a penalty because what we find for most people is that they pay higher taxes and higher Med B premiums when one spouse passes away. I'm going to share with you an example that I built for clients so that when they come in, I can explain to them what is really on the horizon at some point for them and what they can do today in order to overcome that penalty. So let's take a look at how this works. So I've built 2025, 26, 27. This is when we're going to assume someone had passed away in 2026. Now we're in the widow's penalty box. And then in 2028, that future year. And so in our tax planning software that we use, Holistaplan, we're able to build these live scenarios to share with people what it is that they can do today to overcome something in the future like the widow's penalty. In this particular case, I'm going to focus on 2026 here. So you can see I've built their interest and dividends as well as their required minimum distribution of about 18,000, taxable pensions of 75,000, and they have some Social Security of 53,000. This is very common in my practice. What I see with clients coming in, some Social Security, an outside pension, as well as a traditional IRA with required minimum distributions. In addition, some taxable interest and dividends off their brokerage or non-qualified account. So from an income standpoint, this looks very common to what I see every day. You can see that total number for this joint filer is about $170,000 in income. They receive their standard deduction. Now, this is the first of many problems that exist when someone passes away and they end up in the widow's penalty. The first is this, that standard deduction of 35.5 today in 2026 ends up getting reduced when someone passes away. We'll cover that in a second. So you can see here total income of about $125,000 and a tax bill for about $15,340. Puts them in the 22% bracket, 12.3% effective rate. Again, very common here. What people don't realize though is you have a spouse that passes away in 2026, we know in 2027, you now are required to file as a single household, no longer married filing jointly. But let's assume a number of those things stay the same. You're going to get the same interest off your bank account, and your brokerage or non-qualified account still produces dividends and income. No different than when you are filing a joint tax return. However, one of the things that we know is going to happen is you will inherit that traditional IRA. And if the balance was larger on December 31st of the prior year and you're a little bit older, it's very possible that RMD amount increases. And if it increases, which I've illustrated here, going from 18,000 to 21,000, then it's likely that we could end up paying more tax based on this widow's penalty. 75,000, I'm going to keep the same in this example as pension income. However, we are going to reduce Social Security. Why? When someone passes away, what Social Security does is they give you the higher of the two benefits. So one of the benefits goes away, and then the spouse will receive the highest benefit of the two. So in this case, I've just reduced one of the spouses, the smallest, benefit from Social Security. So you can see we have a reduction of income, assuming no capital gains, short, long-term, or losses. You can see our income is now 158. That makes sense based on what we just saw happen with Social Security. We have less income. Okay, well, we also have less standard deduction. Look at this number. We went from 35.5 to 18.5. That's a big deal. And it becomes obvious as we start to look at income, still pretty high relative to last year, because we've lost that additional standard deduction. So in this particular case, that tax bill just went from about 15,000 to 23,000. We've bumped from 22% marginal to 24, and we've also increased our effective rate from 12 to 17%. This is a huge penalty. If you think about the dollar amount here, almost $8,000 is about a 50% increase off this $15,000 number. That is a penalty. So what can we do about that, knowing that we're in that situation and it's only going to get worse? And so when we think about the tax implication of this, we also need to think about Medicare and what happens when you're in this situation and your Medicare premiums go up. Okay, let's take a look at Medicare premiums as it relates to being a single filer, moving from joint to single. This is the Medicare premium chart for 2026. So you can see if you were Part B with joint income, you could make up to $218,000 and only pay about $203 per month. In my example, we had about $170,000 of income, and then it went down to about $158,000 when I was in the widow's penalty example. And so in this case, you could see as a joint filer, at $170,000, they were paying $202.90 in 2026 for their Med B premiums. However, what happens when you end up in the widow's penalty and you're filing as a single filer? Well, remember, in my example, what did we say? That person had about $138,000. So they were just over this 137 number. So what happens to that spouse is that their premiums just doubled from a Med B standpoint. In addition to that, on the Medicare website, you will see for Part D, for your drugs, your Part D premium also goes up. So you had 0 as a joint filer here at 218, and now above this 137, we have 37.50. And so if you combine those two, let's call it about $240 a month, you have almost an additional $2,900 bill on top of that tax bill going from $15,000 up to $23,000. So that penalty in my example is almost $11,000. It comes out to about $10,600. This is very common, and I find that a lot of people aren't thinking about this correctly. They're not pre-planning, doing the things that they can today in order to reduce being in that widow's penalty in the future. What we want you to do is really two things to think about here. One is doing Roth conversion, converting those pre-tax accounts into Roth. You want to do this very judiciously because you don't want to hurt yourself tax-wise each year when you're doing a Roth conversion or your Med B premiums. So You want to take very meticulous data and then decide if it makes sense for you to do a Roth conversion. Okay. The other thing we always recommend is that when we're in this particular situation, when we've mapped out a client's overall distributions in retirement, is that we may end up delaying the highest earner their Social Security benefit until age 70. And the reason why is it gives us more time to convert or drain out these traditional IRAs and not bump tax brackets. So again, if you have a hard time understanding how this applies to you or how to do this, don't just simply take all your pre-tax money and convert it. That's probably not going to be the best solution. You want to reach out and find someone that really understands what they're doing and make sure you're doing this correctly each and every year so that in the event at some point in the future, you don't end up in this widow's penalty box. If you have questions, feel free to reach out to us. We can absolutely help you think this through for your particular situation. Feel free to watch some of our other videos on our YouTube channel to learn more about how to plan your financial future. Thank you. Have a great day.